Margaret sat at her kitchen table in Dayton, Ohio, holding a letter from the IRS with hands that had gone cold. She was 71 years old, a retired school teacher who had spent 34 years grading papers and packing lunches for other people's children. She had always paid her taxes on time. She had always checked her numbers twice. And yet the letter in her hand told her she owed an additional $3,842 because she and her husband Frank, a retired machinist, had crossed an income threshold by exactly $1,100. $1,100. That was all it took to pull an extra $10,000 of their Social Security benefits into the taxable column, bump them into a higher provisional income bracket, and trigger a cascade of consequences neither of them had seen coming. If you file jointly, and if you are anywhere near retirement, what happened to Margaret and Frank can happen to you in 2026. The threshold has not moved in over 3 decades. It was written into law in 1983, and Congress has never bothered to index it for inflation. And millions of retirees cross it every single year without realizing they just handed the Treasury money they never had to give up. Before we go any further, I want to be transparent with you. This video is for educational purposes only and does not personalize tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. What I share here is general information drawn from public IRS publications and widely reported data, and it is meant to help you ask better questions of the people you trust with your money. Now let me show you exactly what the threshold is, why it matters, and what most retirees miss. The number you need to circle is $44,000. That is the upper combined income threshold for married couples filing jointly. Cross it, and up to 85% of your Social Security benefits become taxable at your ordinary income rate. The lower threshold is $32,000. Between $32,000 and $44,000, up to 50% of your benefits get pulled into taxable income. Above $44,000, that number leaps to 85%. These are not 2026 numbers inflated from last year. These are the same numbers Congress set in 1983 and again in 1993 when the 85% tier was added. Think about that. The cost of eggs has tripled. The median home has quadrupled. But the threshold that decides whether your Social Security gets taxed has not moved an inch. Here is what the IRS calls combined income. And here is where most retirees filed jointly get tripped up. Combined income is your adjusted gross income, plus any non-taxable interest, plus 1/2 of your Social Security benefits. Read that again. 1/2 of your benefits counts toward the threshold that determines how much of your benefits get taxed. It is a recursive formula, and it punishes people who planned carefully and saved diligently. If you and your spouse take $24,000 each from Social Security, that is $48,000 combined. Half of that, $24,000, goes into the provisional income calculation before you add a single dollar of pension, IRA withdrawal, or dividend. Add a modest $20,000 traditional IRA withdrawal, and you are already at $44,000 of provisional income. Add $2,000 in municipal bond interest that you thought was tax-free, and you have crossed the line. Up to 85% of your $48,000 in Social Security, about $40,800, now sits in your taxable income column. Let me translate that into real dollars, because the percentage hides the pain. If that extra $40,800 is taxed at the 12% federal bracket, which is where many retirees land, you just wrote the Treasury a check for about $4,896. If you are in the 22% bracket, because you also have a pension and some Roth conversions, the bill climbs to nearly $9,000. That is real money. That is a new roof. That is a year of Medicare supplement premiums for both of you. And most retirees never see it coming because nobody told them that Social Security and IRA withdrawals and even tax-exempt interest all stack together in ways the rest of the tax code does not. Consider Robert and Linda, a couple in Harrisburg, Pennsylvania. Robert worked as a postal worker for 38 years. Linda ran the front desk at a small accounting firm until she turned 66. They built up a respectable traditional IRA together, around $420,000, and they both filed for Social Security at their full retirement age. Their combined benefit came to $51,000 a year. Linda's pension from the firm added another $9,000. They thought they were safe. Then their financial planner, a decent man who meant well but only met with them once a year, suggested they start taking $15,000 a year from the IRA to cover home repairs. That pushed their combined income to over $51,000 on the provisional formula. 85% of their Social Security, about $43,000, became taxable. They owed roughly $5,100 more in federal tax than they had expected. And because their adjusted gross income crossed into a new tier, they also triggered a higher Medicare Part B premium 2 years later through IRMA, which added another $800 per person per year. The IRA withdrawal they thought was costing them 12% in tax actually cost them closer to 34% once you stacked the Social Security taxation, the Medicare surcharge, and the loss of some state tax benefits. This is the trap most retirees filing jointly do not see. The threshold was never indexed. When it was written, the average retiree had very little in an IRA. Pensions covered most of the cost of living. Social Security was modest supplemental income. And $44,000 a year was a comfortable upper middle class retirement. Today, with inflation, $44,000 is barely subsistence in many parts of the country. Yet the tax formula still treats that number as if it belongs to wealthy retirees who should pay more. The result is that middle-class couples who did everything right, who maxed out their 401ks, who paid off their mortgage, who saved for 40 years, end up paying tax on their own Social Security benefits because the threshold has not moved since Reagan's first term. So what do you do about it in 2026? First, you need to understand exactly where your provisional income will land. Pull out your 2025 return. Find your adjusted gross income on line 11 of the 1040. Add any tax-exempt interest from line 2A. Add half your total Social Security benefits from line 6A. That sum is your provisional income. If it is anywhere near $44,000 as a married couple, you are in the danger zone, and every additional dollar of IRA withdrawal, pension income, or realized capital gains pulls more of your Social Security into the taxable column at an effective rate that can feel closer to 40% than to 12%. Second, consider the timing of your withdrawals. Most retirees default to taking from their traditional IRA first because it feels like the path of least resistance. But if you have a Roth IRA or after-tax brokerage account, withdrawals from those sources do not count toward provisional income. A Roth withdrawal is invisible to the Social Security taxation formula. A qualified dividend from a taxable brokerage is partially visible, but long-term capital gains are taxed at a lower rate anyway. Sequencing matters more in retirement than almost any other financial decision, and filing jointly amplifies the math because both spouses' benefits are in play. Third, look at your tax withholding on Social Security and pension income. If you have been caught off guard by a tax bill, in April, you may want to file Form W-4V with the Social Security Administration to have a flat percentage withheld from your monthly benefit. 7, 10, 12, or 22% are your options. You can also file Form W-4P with your pension administrator to adjust withholding there. Some retirees prefer to make quarterly estimated payments with Form 1040-ES instead, which gives you more control but requires you to keep track of due dates. Either approach is better than getting a surprise letter in April demanding $4,000 plus underpayment penalties assessed on Form 2210. Fourth, and this is the one most retirees miss entirely, check whether a partial Roth conversion makes sense in low-income years. If one spouse passes away, the survivor will file as single, and the single thresholds are even tighter. The single upper threshold is $34,000, not $44,000. A surviving spouse in a $60,000 retirement can suddenly find themselves in the 85% tier just by losing one Social Security check. If you have any window in early retirement where your income is unusually low, converting some of your traditional IRA to Roth at the 12% bracket can reduce future required minimum distributions and protect the surviving spouse from a widow's tax penalty later. These decisions are delicate and should always be run by a qualified tax professional, but they are worth asking about. Now let me tell you about a quieter trap that hides inside the threshold: tax-exempt interest from municipal bonds. Most retirees buy munis specifically to keep income off their tax return, and at the federal level, the interest is indeed excluded from taxable income, but it is not excluded from the provisional income calculation for Social Security. Every dollar of muni interest still counts toward the $44,000 threshold. So a retiree who shifts $200,000 into a tax-free municipal bond fund yielding 4% generates $8,000 of interest. That does not show up as taxable, but absolutely does show up in the provisional income formula. That $8,000 can be the difference between 50% and 85% of your Social Security being taxed. Munis are not a loophole for retirees. They are a partial shelter with a hidden leak, and most advisors who recommend them for their tax-exempt status do not explain how they interact with the Social Security formula. Here is another trap: required minimum distributions. Under Secure Act 2.0, the RMD age moved to 73, and it will rise to 75 in 2033. But when your RMDs kick in, you lose control of the timing. The IRS tells you how much you must take out of your traditional IRA every year based on your account balance and a life expectancy factor from Pub 590B. If you have been deferring withdrawals to keep your provisional income below $44,000, that runway ends the year you turn 73. Some retirees see their first RMD and realize they just crossed into the 85% tier for the rest of their lives. Planning for the RMD ramp should start at least 5 years before the required age, and qualified charitable distributions, which we will cover in another video, can help manage the impact for those over 70 and a half. Dorothy, a retired librarian from Cedar Rapids, Iowa, learned this the hard way. She and her husband Harold, a former electrician, live modestly on about $38,000 a year in combined Social Security and his small IBEW pension. For years, they paid almost no federal income tax. Then Dorothy turned 73 and her RMD on a $400,000 traditional IRA came in at just over $15,000. That single distribution pushed them past $44,000 in provisional income and pulled 85% of their Social Security into the taxable column. Their tax bill went from around $400 to over $5,000 in 1 year. Harold described it as feeling like the floor dropped out. What Dorothy wishes she had done, in hindsight, was start converting small chunks of her traditional IRA to Roth in her mid-60s, when her income was low. $1,000 or $2,000 a year would have reduced her eventual RMD and kept more of her Social Security sheltered. Now here's the question I want you to sit with. When was the last time your tax preparer or financial advisor actually walked you through the provisional income formula and showed you, in real dollars, where the $44,000 cliff sits for you in 2026? If the answer is never, you are not alone. Most CPAs are busy during tax season filing returns, not doing forward-looking projections. Most financial advisors focus on investment returns, not tax interactions. The people who do this kind of integrated planning are tax-focused retirement specialists, and they are worth seeking out at least once before you turn 73. Let me leave you with a quick checklist you can actually use. Pull last year's 1040. Calculate your provisional income for 2026 using your projected Social Security benefit, half of which counts, plus your AGI and any tax-exempt interest. If you are within $5,000 of $44,000, you are in the planning zone. Review your withdrawal sequencing. Ask whether a small Roth conversion makes sense this year. Check your Social Security withholding via W-4V. Confirm your pension withholding via W-4P. Update Form 8822 if you have moved recently, so IRS correspondence reaches you. And if you are managing an inherited IRA on top of your own, remember that those RMDs stack on top of your regular ones, potentially pushing you past the threshold faster than you think. Every retiree filing jointly deserves to know exactly where this line sits and what it costs to cross it. The government is not going to send you a warning. The threshold will not move. It has not moved in over 30 years, and there is no legislation on the table to index it. The only protection you have is the one you build yourself, through awareness, planning, and the kind of careful sequencing that turns a surprise tax bill into a predictable number. One more practical consideration worth the time. If you are married filing jointly and one spouse has significantly more retirement assets than the other, the order of withdrawals matters not just for this year, but for the survivor's future tax picture. The survivor will file as single, which cuts the upper threshold from $44,000 to $34,000. If the larger account belongs to the older or less healthy spouse, strategies that draw that account down during joint filing years can reduce the future widow's tax burden. This is not about being morbid. It is about being prepared. A couple in their mid-70s with $800,000 in one spouse's traditional IRAs and only $200,000 in the other spouse's can use careful withdrawal planning, Roth conversions, and QCDs to rebalance the tax impact across both spouses' lifetimes. The math on the survivor's tax situation 10 or 15 years from now is one of the most consequential calculations a couple can do in their 60s. And the difference between doing the planning and not doing it is often measured in 6 figures of cumulative tax. Let me add one more layer most retirees never consider. The $44,000 threshold, combined with the way RMDs scale over time, creates what some retirement planners call the tax torpedo. A retiree might sit comfortably below the threshold in their late 60s, enjoy a few years of low effective tax rates, and then watch their tax bill explode the moment RMDs begin at 73. The torpedo accelerates every year after that, because RMD divisors shrink while the account continues to grow, so the dollar amount of each RMD grows year over year. A couple with $1 million traditional IRA at age 73 has a first-year RMD around $37,000. By age 80, that same account, if it has continued to grow modestly, may be producing RMDs closer to $50,000 annually. Layered on top of Social Security, that income level guarantees 85% of benefits are taxed every year, while also triggering 1 or 2 IRMA tiers on top. The strategic window to diffuse the torpedo is roughly ages 60 to 72, and the tools are Roth conversions, QCDs once you turn 70 and a half, careful asset location, and harvest of capital gains at the 0% long-term rate when your income is low. Waiting until RMDs begin is usually too late. If this helped you understand how the provisional income threshold works, do someone you care about a favor. Share this video with the retired couple next door, with your mother, with your brother who is about to file for Social Security. Most retirees never hear about this until it has already cost them thousands. The more people who understand the 44,000 cliff, the fewer letters like Margaret's get mailed out next April. And if you want more on Roth conversions, IRMA brackets, qualified charitable distributions, or the widow's tax penalty, those are all topics I cover in other videos on this channel. Stay careful, stay informed, and remember that the quiet decisions you make in your 60s shape the tax bill you live with in your 70s and 80s.